let's start with the big beat, really strong numbers this quarter. John, just how much of that, can you give us an idea, was powered by an AI wave?
Well, it definitely was a heck of a quarter, Dani, and 26% up in earnings on top of 25% last quarter. And it was definitely powered by that strategic decision we made to lean into AI and the AI ecosystem. It really started for us back in 2021 when we bought QTS, this big data center business, and it gave us a front row seat in terms of what's happening around AI. And we made a strategic decision, hey, we should lean in here, not just with data centers, but with neo clouds, large language models, electrical equipment, energy. And that decision is paying off, and it's delivering for our clients, which is the most important thing. And what's also very exciting is we're not done here. Just in the second quarter, we announced partnerships with Google and TPUs, with Broadcom and financing chips, with Anthropic and deploying their technology. We continue to see a lot of opportunity in this space to generate favorable returns. We announced a couple of big sales in the last few weeks, one of data centers for $8 billion. We announced yesterday a battery storage company we sold for $7 billion. So AI and that ecosystem and our strategic pivot has really made a difference for the firm and our investors.
Just on that pivot, John, I was really struck last month. You were at a Morgan Stanley conference, and you made the case that Blackstone is one of the least expensive ways out there to play AI today. Blackstone, of course, trades more akin to financials, multiples that look like that. Do you think Blackstone should be trading at tech multiples? Should you look more like an NVIDIA or an Alphabet?
Well, what I would say about Blackstone is we're a company that operates with virtually no capital. We don't have any insurance liabilities. We have virtually no debt. We've shown incredible growth. Look at our earnings in the first half of the year. Today, we're yielding 4%, which is one of the highest dividend yields in the S&P. And yet, when we look out over the horizon, we see real growth potential. We see it with our institutional clients, with our insurance companies, and with individual investors. And today we're trading at a discounted market multiple. Yeah, we see it very differently. But I think as the market begins to see the earnings power of this firm and what we can deliver as we grow, as we generate these great returns from the strategic pivot we've made, I do think the market will change things, a re-rating will come. Sometimes we've got to be a little patient. The key for us is just keep executing.
I guess what I'm trying to understand is just to what degree Blackstone has been made into not just an asset manager, but a pure AI play. And John, a lot of people might look at that and get concerned that you've bet the house on one theme. How do you assuage investors who might be concerned about just concentration risk in AI bets?
Well, we've got a big, diverse firm. Obviously, we've got a very large real estate business. We invest in secondaries. We're in the hedge fund space. We have all different forms of credit out there. Our private equity business owns lots of regular way businesses like Jersey Mike's. So there's more to this firm than that. But I think the decision here to lean in when you see this huge shortage of compute that is out there and an opportunity to earn favorable returns by aggregating capital at scale, having terrific platforms, to me, that makes a lot of sense. So there's more to this firm. By the way, it's a global firm, as you know, as well, with big strength in Europe and India and Japan and around the world. But I feel very good about what we've done in terms of this concentrated focus, because this really is a new operating system for the world, and you want exposure to it. It would be a little bit like, hey, I don't want to own the S&P 500 because there's big exposure to technology growth and AI. I think for us and our investors, we want to deliver that premium return.
By the way, there has started to be somewhat of a market pushback on just the amount of CapEx that's being spent by the hyperscalers. Many hyperscalers who you've partnered with, you can see it in Alphabet results this morning, fears over just that big chunky number they announced in their spending. If those hyperscalers do start to pull back because of the market pushback, how does that impact Blackstone's investments and deployment?
Well, that's not what we're seeing today. In fact, it's the opposite. If you look across our data center platforms, we leased 1 gigawatt in 2024. We leased 2 gigawatts in 2025. And this year, we're on pace to lease at least 7 gigawatts, we believe, which is more than 100 billion of data centers and a couple multiples of that in terms of chips that go inside. If there is a slowdown, then yes, the pace of development would slow. The good news is you're not speculatively building. And I think that's really important. When you think about the telecom boom in the 90s, where people built fiber, something like 20 times more than was actually needed. In this case, we're only building to demand and long-term contracts from very large creditworthy companies. That's really the focus for us. And to us, it seems like a disciplined way to do this. I think fundamentally what people aren't getting is how powerful this technology is at companies. We're beginning to see real-time examples, certainly in customer service, in coding. It's now starting to move to the revenue generation side, where businesses are creating new lines, new revenue streams using this AI. And I think because this tool is so powerful, there's an underestimation of what's happening. We see the power of it, and we're really focused on helping meet this compute shortage.
Well, John, because you use the tool every day too, both at Blackstone, I know, and in your portfolio companies, and you have partnerships like Anthropic. I got to ask, though, there's a lot of fear and perhaps excitement around Chinese open source LLMs that they're cheaper, they're more efficient, and they're just as good as the most advanced models. Have you guys tinkered around with any of them at Blackstone, and would you ever use a Chinese open source model?
Well, yeah, I'm not the tech expert here, but our team has worked with a bunch of different models. I think the bigger issue, whether it's Chinese or American, is will there be a range of models? I think of it almost like automobiles. Will there be very high performance, more expensive, in this case, frontier models? Will there be more regular sedans? I think there's going to be both. And I think what you go back to is, as you bring down the cost of compute, if you can bring down token costs with open source, open weight models, what that's going to mean is there's going to be more demand. That's that Jevons paradox idea. As cost comes down, usage goes up. So again, that will put more pressure on energy needs and data center needs, and that will mean more physical investment. I also think, by the way, another area people are underestimating is what's going to happen when this technology gets deployed in the physical world. We're going to have more autonomous vehicles, robots, defense, space. That's going to require further investment dollars. So I think bringing cost of compute down is helpful, but I think there'll be a range of models for a range of needs.
It's almost as if maybe you were listening to Tesla and Elon Musk yesterday on their earnings call too, John. Can we talk about the non-AI investments? I know, as you say, Blackstone is large, it's global, it has other things. Clearly, you've had some excellent realizations this quarter driven by AI. What about everything else? Because the thing this market had been worried about wasn't AI, it was being able to exit the more traditional companies, maybe ones that were bought in 21 and 22 when multiples were quite hefty.
So what we've seen is really a bifurcation. If you leave AI to the side, what we're seeing in terms of liquidity is for traditional, let's call it AI unaffected businesses, there's pretty good liquidity out there. If you're a medical supply business, if you're a fast food chain, people want to own those kinds of businesses. We're now seeing, even in the real estate market, the logistics area, as people see the strength, given the lack of new building there. We're seeing some large M&A potentially with Prologis in the UK. So there is interest in the real world away from sort of the AI trade. I think where it's harder to get liquidity is where there's more uncertainty around the future. So that is in professional services, information services, software, where people are saying, I don't know what this company is going to look like 5, 10 years from now. Now, in many cases, these are great businesses. They're deeply embedded. They will become agentically forward, and they'll succeed. But for now, multiples have come down, and you're seeing less M&A, less financing activity, less IPOs for these businesses. I think that's going to stay for a while until there is more clarity.
John, can we get more specific? Because I think about a company like UKG, which has been a star for Blackstone in the past, but it's, you know, HR services. It is a software provider at the end of the day. What do you do with a company like that?
Well, a company like that really has terrific connectivity to its customers. If you think about all the underlying employees it serves, what it does, it is an invaluable service. I don't think a business like that is going away anytime soon. It is core infrastructure for companies. On the other hand, the CEO there, Jen Morgan, is doing a terrific job. She's making the business more and more agentically forward, and they're going to have to continue to invest and continue to serve these customers with the newest technology. And yes, today the multiples for businesses like that have come down, but the business is still excellent, and I think will continue to serve many customers for a long period of time. And we've just got to execute.
Hey, John, you're very active. It's the year of the IPO, and that's coming true with Jersey Mike's next week, likely. You're very active with deployments and realizations. Are there any macro signals that you're looking at, be it oil prices and yields or otherwise, that maybe would cause you to tap on the brakes?
Well, we tend to take a bit of a longer-term approach. There's no question in the near term that with the conflict in the Middle East, energy prices are elevated, interest rates are elevated, and that's going to weigh a little bit on market activity. We tend to look through that. We do think inflation away from energy prices is generally subdued, which will allow the Fed to be patient here. We see very strong economic growth at our companies. Our private equity companies had 11% revenue growth in the second quarter, which is pretty remarkable. So our inclination here is, if people pull back, probably to deploy more, because we see pretty healthy fundamentals, a decent inflation picture, and then this productivity we think that's going to come from this massive investment. I think the big issue and risk is, how do you think about businesses in the future, those that are the most impacted, and can they position themselves for a different world?
John, just finally, and you're probably relieved that this has now become one question at the very end versus the entirety of the conversation, but you and the team did note that redemption requests at BCRED have slowed down. Do you expect this to be the more normal, the new normal, maybe a more muted pace of inflows and steady redemptions, or do you expect at some point that redemptions will halt altogether?
Well, I'd just start with our wealth franchise, which Joan Solotar and the team do a terrific job on, is really growing quickly. It's up 16% to $324 billion. And we're seeing very strong inflows in things like our private equity wealth product, infrastructure. BREIT, which got a bunch of attention 3 or 4 years ago, had its best net inflows in 4 years, has delivered 10% plus performance the last 12 months. In credit, to your point, we have seen more muted inflows, which is not a surprise given all the noise. On the positive there, it's early in the quarter, but redemption requests have come down pretty materially. So I would say this will take a bit of time to work through, but ultimately, as we deliver for customers, as they recognize that all the sort of town criers of doom in private credit overstated things, that yes, returns come down a bit as a result of a normalization of defaults and base rates coming down, but that this is a product that will continue to deliver, protect capital, deliver current yield. I think you'll see flows at some point resume in the future. And we're long-term players and are building long-term products. And that is the key to our wealth business. It's frankly the key to our firm. We've got to deliver for our clients.